This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asia set to extend Wall Street gains as the S&P 500 hits a record. Further evidence of moderating U.S. inflation easing risks of a Fed hike next month. Bloomberg learns that OpenAI is on track to generate more than $40 billion of annualized revenue in a boost for its IPO plans. A changing of the guard in Chinese tech, with chipmaker CXMT topping Tencent as its most valuable company, while JD.com posts its fourth quarterly revenue decline since listing. And the Trump administration targets Chinese drones, slapping on tariffs as high as 100%.
I'm Haidi, Stroud-Watts in Sydney. Take a look at the setup for trading across Asia as we round out what has been a hectic week, and it looks like it'll be busy still going into the start of trading this Friday session. We are expecting to see Asian stocks really extend those gains. As Shery mentioned, that sort of evidence of pretty muted or moderating US inflation on the wholesale level, really adding to the as expectations US CPI print that we had earlier in the week as well. That pullback in oil prices that we see will be helping that bet the Fed will refrain from raising rates comes that September meeting. But this is a picture as we see the S&P 500 continuing to notch up those gains. We're seeing equity index futures higher in Japan, in South Korea as well. The oil picture is this. We're seeing oil holding that decline, down 2% in the last trade for Brent crude. New York traded crude looking near flat at the moment, but still at around that $81 a barrel level after a decline of 2.5% in the previous session. Shery.
Heidi, let's get into the trading day with our team. Markets reporter Anthony Stevens in Hong Kong, our AI reporter Rachel Metz in San Francisco, and Bloomberg equity strategist Sunny Banja, who joins us from Sydney. Anthony, let me get started with you because we could see some positive upside here across Asia, especially memory and storage, given the latest tech news out of Wall Street.
Yes, SanDisk has a pretty clean read-through to Asia to start in Japan and in Korea. They saw the NAND market absolutely exploding in size. They said it was structural. They said the pricing power that they have is very durable on both the margin and the absolute pricing side. And they were talking up kind of the innovative space in the fact that high bandwidth NAND can catch up and kind of help to replace high bandwidth memory. And that's been kind of a transition that's been in the market for a little while after the Chinese models started to lean very heavily on NAND flash. So the Taiwanese players in NAND flash have been rallying for quite some time. Now that positioning is lighter in Samsung and Kweichow, those names have started to rally as well. So and you're seeing this very early pop in Samsung here on next trade. It'll be very interesting today to see how much that momentum continues. Also interesting from the US point of view, SanDisk is the top performing member of the S&P. It's up 500% plus this year. So if that name can continue to post double-digit gains, retail might get more confident. This memory trade will find its feet given this kind of guidance.
And Sunny, of course, we're watching a lot of the Chinese names. We spoke about CXMT and this sort of changing of the guard in the Chinese tech space, but also this DeepSeek price hike is an interesting one too.
Yeah, that's right. What we've been seeing out of China is no longer cheap models, but capable models. The capability has come closer and closer to the frontier in the United States. And now we're seeing a path towards monetization of those models. And that's going to be important to create a self-enforcing loop where the Chinese models can monetize, use that money to continue to invest and train, and continue on that frontier curve. So the DeepSeek hikes are probably a trend that we're going to see across a lot of these Chinese models over the coming months and years.
What's happening in the U.S. and Western models, Rachel, because we are now seeing this reporting about OpenAI potentially doubling its run rate from the end of last year?
Yeah, what we are hearing is that it is seeing this revenue run rate in the 40 billion range, which is quite a lot more than what we knew from last year, where I think it was more like 20. And what's interesting here is it's not just across a piece of its business. It's not just in its enterprise business. We are seeing growth. What we understand from talking to our sources is it's not just coming from enterprise and its coding product Codex, but it's also coming from ads-related business and also its consumer business. It's important to remember here that the company's consumer business is still the largest number of users that it has, like the vast majority of the 1 billion weekly users that it has. It just recently hit that mark. Those are still consumer users.
And Rachel, of course, we're watching on Anthropic investors really expecting the startup to get this $2 trillion or more valuation.
Yeah, I mean, it remains to be seen if that is what's going to happen, but it would be quite interesting if they were able to achieve that. It is such a lofty figure. The company has grown a lot, though, over a short period of time. We've seen its revenue rising and users are increasing. And it also, I mean, it has some tangles with the US government as well, but it also has what are widely acknowledged as some of the most powerful AI models amongst the AI labs. So it'll be interesting to see if it achieves that in advance of the IPO or if or when that happens.
And funding, of course, all of this AI boom will be huge. We're hearing the latest from AMD when it comes to relying more on debt, Anthony.
Yeah, and that speaks to the capital markets activity on all sides of the capital structure, right? So this follows the Intel massive block that has done remarkably well and was priced very tight. Now the speculation is that the AMD $4.75 billion debt that is coming in 3 tranches is also being priced tight. And this is in the context of a US IG market that is already trading very tight. So there is an incredible amount of demand for tech debt. It has to be said that this company in particular is in a very strong financial position. They don't have much debt anyway. This deal, in addition to its existing debt, is still not more than the cash that they have on hand. And the 2027 market that they expect is going to be bigger than the entire market in 2025. So they're in a very strong financial position. Their confidence is very high, and investors seem like they share that confidence on the debt side. On the equity side, it's also quite supportive that other firms in a similar space can get off equity deals so cheaply.
Sunny, we've talked at length about the disruptive power of what we're seeing out of China AI, right? It's incredible that maybe even less than a year ago, if you talked about Frontier, you're talking about the big 3 in the US. It seems like we're getting new releases every week now from China. What's to come here? You spoke about sort of, getting into that, I guess, almost a virtuous loop for cost.
Yeah, I mean, the thing about the Chinese models is, China tech has naturally always been first, let's gain widespread adoption. So you see that happen across China, and you've seen that happen in Western markets as well. Token usage of Chinese models is far greater than of Western models. But now it's coming to a path where China needs to go onto a reinforcing loop where they can use profits or revenue inside China or outside China to now train more capable models. That's going to require compute. It's going to require memory. We've already seen CXMT, very large IPO, a lot of fanfare. YTMC has also caught up with a lot of the NAND competition. But Huawei is also producing some of the highest grade chips in China, and that's going to be an expensive task. So a lot of this requires a self-funding ecosystem like we have in the West. We kind of need to replicate that now in China.
Yeah, we saw that revenue beat when it came to SMIC, right, Sunny? What we're seeing right now in the Chinese markets, there's a lot of exuberance around anything related to AI technology. But we're also seeing the consumer malaise, the lack of demand. Is that what we got reflected in the results from JD?
Yeah, absolutely. JD is a great expression of the Chinese consumer and spending patterns. So I think we saw that in the results that came out yesterday, where it's still the business model still struggling to shake off the weak Chinese consumer. I think the administration is obviously watching these developments in terms of the economy. There is talk about stimulus that might boost sentiment, but really it's going to come down to the property market. And if we have seen the worst of the price declines in Chinese property, and so far the tier 1 cities are starting to indicate maybe prices have bottomed, and that's going to be important direction for consumption leading into the second half and into next year.
Anthony, it's interesting. I was reading your morning note earlier. You talk about obviously the Chinese industrial overcapacity is something that we look at with every wave of this sort of development, right? And now the concentration is what they're doing when it comes to AI. Does this have the ability to lift the broader economy out of the broader malaise that we've been talking about?
Well, one key differentiator of the AI kind of growth is that there's margins, there's pricing power. People have demand for this, right? They're not pumping out capacity and then dumping it at cost or sub cost for like a winners take all kind of dynamic. So in that sense, it's quite different from some of the light industrial manufacturing exports that China has indulged in year to date. And this includes the EV space where, it followed that playbook. Here you have completely full order books, whether you're talking about Huawei or CXMT or YMTC or Gigabyte or any of these smaller players. So this seems to me a much more healthy ecosystem where people are actually making money, as Sunny says, and reinvesting that money in a rational way to make more money, frankly, right? And that is much more healthy in terms of lifting the overall Chinese economy. And this speaks to why the Chinese government has really put its weight behind this tech sector. They are not conceding the AI fight to the US because this is such a profitable and kind of healthy part of the Chinese economic story.
Rachel, what are some of the next milestones that we have to watch out for in AI models, whether it's in China, like we've been talking about with DeepSeek and just others, smaller ones IPOing, or in the US, where we're still waiting to see who gets to market first, OpenAI or Anthropic?
Yeah, I think there's a bunch of different things that you need to look out for, but it also kind of depends on what your interests are, what parts of business you want to focus on. I think we're going to see some interesting changes with the model capabilities in the coming months over the next year. We'll see more cybersecurity capable models for sure, and we'll also see advances in specialization in other areas, perhaps science. That's one that a lot of the companies that are making the largest models have been working on. I think we're also probably going to be seeing more of the companies pushing toward an IPO. I mean, it is certainly possible as we look ahead that we will have one, possibly two, but I think one is reasonably likely given what we know thus far in the not so distant future in the US. So we'll have to keep an eye on that and see what happens in the coming months.
Our AI reporter Kweichow Moutai, along with our Bloomberg Markets reporter Anthony Stevens and our equity strategist Sunny Banjia. Still to come here on the Asia Trade, the US imposing heavy tariffs on imports of drones and their components as it moves to reduce dependence on foreign suppliers, especially China. We have the details next. This is Bloomberg. Well, President Trump is applying a 100% tariff on some imported drones and their components. The move could heavily affect Chinese manufacturers like DJI, which last year accounted for about 70% of the US market. For more, let's bring our Bloomberg Digital Politics editor, Romy Vaghi. So, Romy, this seems quite clearly aimed squarely at China.
Indeed, and this stands to have a huge impact on the drone market globally. I mean, as you mentioned, China is the world's dominant manufacturer of drones, and DJI accounts for 70% of the U.S. commercial drone market. And in its announcement today, the U.S. said it was too reliant on foreign-made drones. But this move, first of all, can boost drone makers in other countries that have cut trade deals with Trump. We're talking about the EU and Switzerland and Taiwan and Japan, and tariffs there on drones would be 15%. And the UK only has 10% on drones made in that country. So, and we're seeing shares of U.S. drone makers jump post-market. So yes, I mean, this stands to have a huge impact globally. And also, I should note that this is the latest in the tit for tat between the U.S. and China on trade. I mean, we saw China recently announce retaliation for an earlier move by the U.S. government to restrict foreign robots. And just this week, China announced higher deposits on imports of U.S. pecans. So all in all, it seems like a measure from one country is met by another retaliatory measure by the other country.
What does this potentially mean, given that we are still expecting that Trump-Xi meeting in September in the US?
I mean, this obviously raises the stakes for this meeting between Xi and Trump in September in the United States. I mean, each side is going to use this as leverage for concessions. And of course, Trump loves to use tariffs. And even though the Supreme Court struck down the global tariffs, he's been trying to use tariffs by saying that they're for national security grounds. So as long as Trump is in office, we will expect him to try to use tariffs, and this will make diplomacy next month very, very tricky. None of our reporting is indicating that the meeting is off. We noted that even in the last batch of retaliation from China, that the response was calibrated to make sure that the meeting wouldn't be derailed. But of course, this just raises the stakes enormously for this meeting next month.
Romy Vaghis, our Bloomberg Digital Politics editor, and on the topic of how we see Trump's tariff diplomacy returning to headlines, we have heard from President Trump agreeing to at least consider Australia's request to consider a full exemption, or at the very least no increase to the tariffs that have been imposed by the US on Australia. That's according to Australian Prime Minister Anthony Albanese making these comments on Friday. He said that the free trade agreement was discussed with the US, as well as the country's record in dealing with these issues such as modern slavery, during a phone call that he held with President Trump on Thursday night. So saying that they'll continue to work closely when it comes to advancing Australian and American interests, including that in critical minerals. At the moment, Australia is subject to that 12.5% tariff rate, and the Trump administration is collecting between 10 to 12.5% duties from most major trading partners. So that is a little bit of upside, but we are expecting broad downside with an indicated open of about 0.5% softer for a third straight day here in Australia, Shery.
And it's interesting that you mentioned the tariff risk around markets, right? Because on the other hand, we have seen the optimism around tech really propelling markets in the U.S. Right now, futures not doing much, but in the overnight session, we had U.S. stocks reaching record highs. A lot to do with, of course, the earnings results. Not to mention that here in Asia, we'll be watching the likes of memory and storage names around the fact that SanDisk just released a new model for revenue growth. And that led to a lot of these names across the U.S., Micron, Western Digital, just gaining ground. And of course, at the same time, we have the concerns around sovereign debt, right? Take a look at treasuries, because you do have to keep an eye, not only just in bond yields in the U.S., but here across Asia as well. The 10-year JGB yield, for example, very close to that 30-year high. We have seen the 30-year treasury auction in the U.S., yielding the highest in 25 years, just coming to tell you how investors are demanding more compensation when it comes to the growing deficit. We'll have plenty more. This is Bloomberg.
Take a look at how we're setting up for this final Friday session here in Australia. Looking like downside for a third straight day. We're seeing indicated open softer by about 0.4% once we get into the start of cash trading in just about half-hour time. We will be watching potentially the downside pressure on some of the energy names. Of course, it being an energy-heavy market here in Australia, we have oil holding those declines, with New York traded crude giving up earlier declines. I will say we're off those session lows, certainly trading just above that $81 a barrel level there. Well, as AI adoption accelerates, India could see a sharp increase in power needs from data centres. Tata Power CEO Praveer Sinha expects about 30 gigawatts of demand by 2035, while other estimates go even higher. In the latest episode of our emerging podcast series, Manika Doshi takes a look at whether the AI boom has India headed for a grid shock.
I'd love to start talking about the Google experiment, as we call it, where Google has committed $15 billion to build an AI hub in India to serve India's needs, but also to serve Google's needs across the world or across the region. And to do that, it is not only going to set up captive power, but it has also just been granted a deemed distribution license. Explain to me the kind of pressure AI is going to put on the power estimates that you all have shared so far. And what do you make of this Google experiment and how it's going to work?
So right now in the country, we have about 1.5 gigawatt of supply which goes to data centers. With whatever has been announced, we are expecting that this will become about 10 gigawatt by 2030 and about 30 gigawatt by 2035. So that's the type of number that now from 1.5 to 10 is not a great number. Mohit will agree that we'll be able to cater to that. Even 30 gigawatt by 2035 is not a great number. We'll be able to handle this. As far as you mentioned about the DEEM license, the
Google experiment.
Yeah, the Google experiment is because when they give a DEEM license, then as a distribution company, you don't have to pay the cross-subsidy charges. Now, when you do renewable projects and you are buying power, you need to pay cross-subsidy charges to the grid. Here, you will not have to pay cross-subsidy because you are a DEEM licensee and you can buy that power. And some of the cross-subsidy surcharge or the other surcharges that one has to pay, you don't have to. So that's it protects. Also, it gives you the freedom that within your campus or within your area, you can have your own network. You can bring the last mile connectivity from the grid to yourself. And to that extent, it gives you the flexibility of arranging power and making it more competitive compared to the otherwise industrial power that you would have consumed.
Assuming there will be humongous demand for data centers, given AI adoption, across the country, do you expect that most of them will rely on captive power and on this sort of deemed distribution license, thereby remaining entirely or almost off-grid and building their own parallel power structures, to the national grid?
So our point of view is slightly different from what Prabirji has on AI data centers. We feel they are likely to be bigger than 30 gigawatts. May not be in 2035.
AI demand, you're saying, is going to be bigger than 30
because India is actually very uniquely positioned in terms of supplying power. And India is also uniquely positioned in the sense that we can do RE-based supply at much larger scale to these data centers, because what we understand from the limited interactions we've had with most of these people, their requirement is like today.
Yeah.
They are keen to have the supply starting in the next 18 months. They don't want to wait for the next 5 years to set up a coal-based or whatever kind of power supply. They want it. So RE is very
renewable energy.
Renewable is actually the one which can do that in the shortest time frame. And incidentally, as per our research, that's also the lowest cost, whether you look at it on a 24/7 flat block basis or as an intermittent supply. So we feel that data centers could be a big business opportunity in India. Of course, assuming that they will all comply with the Government of India regulations for storage of data and so on and so forth.
And you can hear more of that conversation on the Bloomberg Emerging podcast, available now across platforms, including YouTube, Apple Podcasts, and Spotify. Take a look at the emerging markets universe right now. Softer U.S. inflation, including not only the PPI numbers overnight, but the CPI matching expectations, helping the non-dollar side. But the Iran risk is capping those gains. This is Bloomberg.
There's very interesting strands that we're sort of trying to tie together as we head into the end of the trading week, Shery. And one of them is really this renewed focus on US Treasuries, particularly that pressure on financing in the long end. We saw that in full force overnight, right? That 30-year auction, the costliest US debt auction for the 30-year since 2001. So at 5.216%. And that is the most that investors have demanded in terms of just wanting that extra compensation to be able to get that debt. And all of this is starting to feed through into the broader economy, right? And it's pretty poor timing, in particular for the Trump administration, as we get into the sort of countdown towards the midterms there. So not great news for Scott Bessent, certainly, or the US Treasury. We're also watching the revival of the AI trade here in Asia. We saw Japanese stocks seeing gains yesterday. We're looking like a pretty good start for the Nikkei 225. And of course, when it comes to Korea, things are really good again.
Heidi, I gotta say, I stopped listening when you said the end of the trading week. Happy Friday, everyone, and it could be a risk-on day again for the Asian markets. Of course, we had a very positive lead-in from Wall Street overnight, but at the same time, the Kospi is already in a technical bull market. You can see right there gains of more than 20% since the recent low. And this is coming after a sell-off in July of 22%, and yet year-to-date, we're still up about 60%. Volatility has come down. Foreign investors are buying again, but of course, a caveat, they've still pulled more than $100 billion already from this market. Our next guest is maintaining her 2026 Kospi target of 10,000 to 11,000. Let's bring in Cindy Park, head of Korea Equity Research at Nomura. Cindy, great to have you with us. So does this mean that the deleveraging of this market is finally done, or are there still excess positions? And what are you looking at when it comes to the speed and perhaps composition of this rebound?
We think that maybe deleveraging may not be completely over, but definitely we've come down significantly in the deleveraging process. But I think the way I view this deleveraging is sort of a resetting process for Kospi. So fundamentals for Kospi has not changed. It remains quite positive, driven mainly by the AI data center theme, but it's not limited to just AI chain, but also across different sectors, including financials, defense, auto, healthcare. So there's a diversified sector that actually can re-rate Kospi higher. I think we're halfway through the re-rating process. And I think what we saw in first half is, as you mentioned, somewhat of an unhealthy re-rating, partially led by these many of these ETF products that were largely bought by retail investors. But moving into second half, hopefully the retail investors have learned their lessons, as well as the government and the regulatory bodies, the risks related to these leveraged ETFs. So the next leg up for Kospi might be a healthier one. Yes.
Right. So where do foreign investors stand, and why aren't they jumping into this market again? What will it take to make them tolerate more volatility in the Korean space and perhaps a bigger allocation?
So foreign investors have sold about $150 billion of Kospi year to date. And what we saw in first half is that at every inflection point of Kospi, for example, Kospi started out at 4,000, moved on to 6,000, 7,000, and peaked in June, 9,000. At every juncture, foreigners sold massively. And that, I think, is not largely so much related to fundamentals, but due to technical and mechanical reasons, which include portfolio rebalancing. Because of the heavy concentration of Kospi market cap on the two memory names, and accordingly, the foreign investors' portfolio also being concentrated
Cindy,
in the two names. I think when it... Mm-hmm.
Go ahead.
Yeah, so whenever those stock prices exceeded the limit, they had to sell for mechanical reasons. I think moving into second half, I think that will likely continue. So it's inevitable. But if fundamentals can actually go beyond that, then Kospi can go further.
Cindy, in your notes, you actually see this re-rating of South Korea driven by corporate buybacks as well. Are these corporate buybacks going to be cyclical, or can they be long-term structural changes in the South Korean market?
Yes, so somewhat similar to Japan, we expect Korea equity market to see re-rating driven by corporate buyback. I would say at this point, largely driven by the two memory companies, Samsung and Hynix, which should amount to about 120 trillion won this year, moving on to 270 trillion won next year. Now, that's actually equivalent to what foreigners sold in first half. Structurally, I think this will be a pillar for Korean equity market, is Kospi in particular.
You talk about the concentrated positions when it comes to Samsung and SK Hynix. How big of a risk is a competition that potentially could come from Chinese hardware?
Of course, that has been an issue, but at this point, we have to look at different segmentation of the memory and the semiconductor chain. So at this point, we don't think that that's a near-term risk, moreover, because the supply for memory is in shortage right now, and that's really the key re-rating point for the memory name. So I think at this point, I think the likes of CXMT and the competition is not going to be the key hurdle for memory stock prices or Korea equity market.
Cindy, before we let you go, I just want to see your view on what's leading to this weakness on the Korean won. We are looking at it having strengthened towards that 1400 level against the greenback. But considering how much of a rally the Kospi had seen, why do we keep seeing this structurally weak Korean currency?
So if we look at the actual Korea's FX reserve, the huge trade surplus, record high trade surplus that we expect for the year, in theory, Korean won should be much stronger than where it is right now. But what's derated Korean won, in our view, is the exodus, the heavy selling by the foreign investors. And in terms of, if you look at the number, that really has been the key cause.
Cindy Park, good to have you with us, head of Korea Equity Research at Nomura. We have more ahead. This is Bloomberg.
Is the Bank of Japan going to be hawkish to support the currency? And heretofore, they've been a bit deliberate in terms of moving it. This moving in September to sort of stabilize the currency is a big deal. Intervention, I've watched intervention happen over time. You need to really keep going with a lot of firepower. I would argue it's not the most durable way to get there. You got to get monetary policy to a place that people believe that you're going to raise the rate, you're going to be hawkish when you need to be. And I think out of Japan, we need to see that. And I think, I think you're going to see a move in September. Maybe they wait till December, but I think that'll be important for the markets to stabilize.
Yeah, markets pricing in more than a 60% chance of the BOJ actually hiking in September. That was Rick Reeder of BlackRock speaking to Bloomberg earlier. The market has really shifted when it comes to not only whether or not the BOJ will actually hike rates in September or in October, but what happens after that, right? And especially given the weakness of the Japanese yen. On the other hand, you've actually seen some strength for those exporters. You've seen the normalization of the BOJ, the tightening helping some of those banks. We've seen the earnings results, and you can see right now futures pointing to more upside after 3 sessions of gains. We're watching the JGB side of things as well. A little bit of a mixed picture recently, but the 10-year yield is very close to the last month's 3-decade high that we saw. Do keep an eye on memory and storage names given some of the news overnight from Wall Street, including around SanDisk. But as I said, a weaker yen, a key driver of earnings strength in Japan. Investors are increasingly looking past currency-driven gains, though, raising the bar for many companies. Japan Equities reporter Alice French joins me here in the Tokyo studio with more. So what was the picture overall in Japan now that the earnings season is sort of wrapped up?
Yeah, I mean, look, it's actually been a pretty good season. More than 2/3 of companies coming out and beating expectations. Of course, we saw a lot of strength in the tech space, AI, those chip gear makers, of course, memory, cables, all of those things getting a lot of tailwinds from strong demand. We also, of course, did see some strong prints from those exporters, including the autos, and they do get a boost from the weak yen. Of course, as we know, it kind of went down below that 160 level at one point, and that has been a big boost for the exporters. So it was a pretty good season, but it's definitely getting more difficult, I think, for companies to impress investors with their earnings as uncertainty around Forex is growing, basically.
Of course, a lot also depends on how these companies have assumed the yen would trade later, right? So what sort of implications can we have from a stronger yen compared to what these companies have already baked into their earnings forecasts?
Yeah, and look, a lot of Japanese companies are very conservative in terms of their yen forecast, and I think that also contributes to the fact that they've been able to beat expectations, right? But as you say, if we do see the yen starting to go on a kind of more strong trajectory, which I think a lot of people are now starting to expect as there's more talk, as you mentioned, of the BOJ potentially hiking more quickly. We've, of course, seen joint intervention now, not just from Japan, but also from the US. If we do start going in that direction, yeah, it is going to be pressure, particularly for those exporters, particularly for autos. Now, it's difficult really to quantify to what extent it could actually hit earnings. But I think we've seen in the kind of immediate aftermath of a lot of these earnings reports is that it's becoming more difficult to kind of get that share price boost afterwards because people are thinking, well, you know, are the good days going to be over for these exporters? And I think it makes it much more difficult to bet on them as a sector.
And then when it comes to conservative yen forecasts, perhaps also counterintuitive in the sense that they've been conservative about a lot of things, right?
Yeah.
Always Japanese companies guiding conservatively. But you were talking about the Bank of Japan impact. Now when we look forward and what we have experienced in the past with the last couple of rate hikes that we've had, what has been sort of the implication that we could expect, whether it's in September or October for the equity markets?
I mean, I think it's all going to be about communication. Of course, we all remember what happened in summer 2024, and it did result in a big crash, right? We had a sudden appreciation in the yen, and it was not good for equities, but that came mostly as a surprise, okay? I think if these rate hikes do come and if they're expected and the market is ready for them, it shouldn't have too much kind of negative impact. Now, of course, as you mentioned there, banks, they do get a tailwind from these higher interest rates. And so I think banks will be something that investors will be looking at. But at the same time, of course, if we do see the yen starting to gain, even if it happens somewhat gradually, it is going to be a little bit of a downside for those exporting sectors. And I think we'll see investors starting to be a bit more selective when it comes to exporters. Now, of course, a lot of companies in the tech supply chain also benefit from a weak yen, but they've also got tailwinds from the AI boom. And so I think a lot of investors will kind of be looking for companies that have more to offer than that weak yen boost.
Yeah. How are investors, as you say, adjusting in terms of being selective here? Because it gets really difficult, right? For me, I kind of am skeptical that we will be able to break the 155 level, given even the past interventions, we couldn't get through that wall. But I wonder, given the uncertainty, what does selective mean for these investors?
Yeah, and it's been interesting because we've been speaking to investors in the past few weeks and people are really split on whether they think we could really kind of break that 155 level and whether it would actually be good or bad, because we have sort of got to a point really where the weak yen is starting to almost do more bad than good when it comes to kind of domestic consumption and inflation. So when it comes to selectivity, I think a lot more investors are now starting to look at those kind of domestic demand driven sectors, whether that is retail or food related, especially as we know that the food tax is going to be coming down for a while too. And then within those exporting sectors, as I say, I think it will be looking for those companies that really have more upside from the tech supply chain. A lot of the chip gear makers, they've already rallied. Of course, we saw a bit of a come down last month. I think a lot of investors are starting to kind of diversify within the AI supply chain and look for those companies that make those sort of really niche products that still look undervalued.
Alice French, Bloomberg's Japan equities reporter, and really Alice has a point here when it comes to the double-edged sword of the Japanese yen's weakness, right? We're talking about a K-shaped economy. Japan's economy, yes, showing signs of life, rising wages, inflation just below the central bank's target of 2%. But young workers are reaping the benefits. Pensioners are actually feeling the strain of a higher cost of living and a weak yen. Take a look.
On a Saturday afternoon, thousands of people packed this convention center in Tokyo for an investment expo, looking for new ways to build wealth, from real estate to cryptocurrencies to gold coins. Among the speakers, one influencer tells the audience she accumulated $431,000 in wealth while still in her early 30s. She used to earn only $1,200 in her 20s. She's part of a shift in how Japanese people are choosing to invest instead of save. For 3 decades, Japan unleashed economic stimulus while prices and the economy stayed flat. Now inflation is back around the central bank's 2% target, and it's looking like it's here to stay. With rising prices, profits are growing. Workers are getting the strongest wage gain in decades. The stock market is near historic highs, thanks in part to the AI boom. And with it, animal spirits appear to be coming back.
With everything happening around the world, I worry about my financial future, whether I'll be able to support myself while I'm working and after retirement. I wanted to reduce that uncertainty, so I became interested in investing.
The benchmark Nikkei 225 index has surged over 20% so far this year, and first-time investors who piled into stocks with the help of a government tax-free savings program have ridden the wave. It's helping fuel a growing narrative of Japanese dynamism.
Japan is back.
But there are fears that inflation is also worsening inequality. Analysis by Nomura shows consumption in 2025 for the top 20% of the population far outpaced that for other groups. Chieko Sugai lives in Murakami, a 5-hour drive from Tokyo. The 72-year-old widow finds surviving on a pension of around $670 a month increasingly difficult.
The price of kerosene rose to 180 yen, and I was really shocked. That was what worried me the most. I used to be able to keep my heating cost under 30,000 yen somehow. But suddenly I had to pay 36,000 yen. That took a big chunk out of the money I have to live on from my pension. It is quite hard.
Sugai isn't alone. This food truck driver sees a wider trend.
People used to shop without paying much attention to prices, but now they're asking, how much is this? And checking their wallets before deciding what to buy. Because many of our customers are senior citizens living on pensions, they're the ones hit the hardest. That's why we can't increase prices too drastically.
For households with lower incomes, the weak yen is expected to continue eroding savings.
A weak yen is great for the stock market because it improves earnings, but at the same time it's bad for the Japanese people because Mr. and Mrs. Watanabe is losing purchasing power.
A Yomiuri poll in July saw Prime Minister Takaichi's popularity plunge to 57% from a high of 69%. Among respondents, 71% said their major concern was the cost of living. Takaichi has sought to cushion the blow of higher prices with subsidies and has decided to suspend the sales tax on food. The question is how much those measures will resonate with Japanese voters.
And we'll be watching the shares of Kioxia that could pop after we saw SanDisk overnight announcing a financial model for revenue growth at an investment event. But that pop of about 9% is not just for Kioxia. Do keep an eye on Kokusai Electric, TDK, Nidec in Japan. Also in South Korea, of course, the really iconic Samsung SK Hynix as well. This is Bloomberg.
The anti-aging movement is no longer just for humans, with pet owners increasingly turning to experimental treatments and even longevity drugs. But as they rush to ensure their cats and dogs live longer, veterinarians are advising caution. Bloomberg's national healthcare reporter Anna Edney joins us now with more. And look, I get it, Anna. I have an 18-year-old cat at home who is on, quite the regimen. But we are seeing some real extremes here.
Yeah, I talked to a number of people and my co-author Annika as well, who are seeking out a lot of things that I didn't really know about before this. They're using red light therapy on their dogs and cats. They're trying out peptides and also this experimental drug called rapamycin to try to extend the life of their pets. And that's on top of a lot of other things. They're trying, supplements and different things that they're hoping can help them live longer.
I gotta be honest, I actually searched for red light therapy for dogs on Amazon. Didn't actually buy them, but I do understand why so many of these, not only big health companies, but also newer startups would really be in this business.
That's right. I mean, this is a huge market. Just in the U.S. alone, it's expected that pet care will hit $165 billion this year, and that's kind of different from a lot of this stuff we looked at because it's so kind of on the extreme. But you have companies who are seeing this, and they know that that's something that people are going to want to get into with their pets because they're already trying to get into it for themselves as well. So there's a company called Loyal, which is trying to be the first to have an actually FDA-approved longevity drug that could extend the life of pets. And then you have some of the bigger established ones that are, looking for ways all the time to extend life, to try to work on those diseases that are really tough to cure: cancer, kidney disease, particularly for cats, and just find ways that, that we can add on to what's already helping pets live longer. Their lives have been extended through vaccines and better nutrition and things like that have already taken place.
Bloomberg's national healthcare reporter Anna Edney there. Let's take a look at how markets are shaping up. So we head into the end of the week, obviously, here in Asia. We're looking pretty good in terms of most Asian markets, with the exception here of Australia, looking to extend gains as we see further evidence of that moderation of the US inflation outlook. The pullback in oil prices certainly reinforcing that sanguine picture as well, that the Fed won't need to do anything in that September meeting. There is going to be some pressure when it comes to sovereign bonds, as we see particularly that 30-year Treasury auction, the costliest since 2001, as these mounting concerns over the US fiscal debt situation as we head closer to midterms really becomes a key thematic as well. When it comes to Nikkei futures, we're up to that 1.5%, looking to extend those gains. That sort of AI demand rally is being revived again, and that is obviously playing through to the Korean markets as well. Kospi futures looking like we'll see a pop at the open, particularly as this market has returned into that bull territory. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens in what could turn out to be a risk-on day, Haidi, across Asia. Of course, we had Wall Street at a record high overnight, and we're watching those tech names, memory names across Asia. At the same time, cooler U.S. PPI really perhaps reducing those odds of a Fed rate hike to come.
Yeah, that pullback when it comes to oil certainly helps the broader inflation picture as well, even as we continue to see not a great deal of progress when it comes to the US and Iran war situation. But certainly, Shery, looking like we'll end out the week on a high note.
Yeah, take a look at how Japan is going to come online, because the focus has been solely on the Japanese yen, very close to that 160 level against the US dollar. Of course, we have seen some upside for Japanese equity markets. A lot of those exporters gained ground on a weaker yen, and we have given up about half of that gain that we saw after the US-Japan intervention, and we continue to be pressured despite the fact that Bloomberg has learned from sources that the BOJ is ready to announce a hike, whether it's in September or October. The reason that we're not seeing a lot of that impact on the markets is because the markets are thinking, okay, fine, raise rates in September or October. What happens after that? The pace of tightening after that hike is a key question for markets right now. Do keep an eye on those tech stocks as well, because, of course, we are following those memory names, storage names. We're talking about Kioxia. We're talking about all of those that operate on the semiconductor side of things, like TDK, Nidec component makers as well. We had heard from Sandix overnight that they announced a new financial model for revenue growth. So that also really expands to South Korea, right? Take a look at Samsung, take a look at SK Hynix. A lot of those memory names are, of course, take up more than half of the Kospi. And right now we're seeing some gains, about 2.5%. it's really interesting to be following this Kospi market, right? Because we have seen volatility now fall to the lowest level since April. We have seen the Kospi now in technical bull market territory, and this after a historic rout in July where it lost about 22%. So it's a good thing volatility seems to be coming down in the sense that it will really relieve some of the angst around foreign investors as well that have been buying a little bit more of Korean equities this week, but still year to date net sellers of more than $100 billion. The Korean won also seeing a little bit of strength today, Heidi.
We're also watching US Treasuries, of course, after what was really an eye-watering yield that was drawn in that 30-year auction overnight. Really, you're seeing investors forcing the hand of Scott Bessent a bit in terms of how much they're demanding for compensation, given these mounting concerns over the fiscal situation in the US, over the uncertainty over the inflation outlook, the war risks, and all of this as we head towards midterms, right? But take a look at what we're watching when it comes to the short end. Not too much of a move there, but we are seeing some interesting moves in gold. Steady as she goes at the moment after an earlier retreat. We've really seen gold tracking at pretty close to that 10-week high, but that pullback as we have that reassessment of expectations from the Fed there. Australia looking like one of the markets that will miss out on any kind of rally regionally today. We're down for a third day. In fact, I think we've been off for 5 out of the past 6 trading sessions, 0.7% lower in the first few minutes of trade here in Sydney. Joining us now is Tim Waterer, who's a chief market analyst at KCM Trade. Let's start off with what's going on with Treasuries at the moment. How much more pressure are we going to see, particularly when it comes to the long end?
Good to be with you, Heidi, and I think you really mentioned it there, is that the market's really demanding an increased premium to absorb that government debt at the moment. So I think what's interesting to note is that the 10-year yield's pretty much where it was a week ago, and in that time we've had soft CPI, soft PPI, and a dismal jobs report. So the yields aren't reacting to that economic picture at the moment. So I think what's that telling us is that maybe the bond market a little bit more worried about the US economy longer term than what the Fed is, perhaps.
In the shorter term, though, this week's data gives a little bit more credibility to the dubs that want to be patient, but not out of the woods yet for September, I would have thought.
Not out of the woods. A lot can happen between now and then. Certainly with oil prices, they're the rogue element for central banks at the moment. So that's a difficult one to predict. But certainly inflation figures heading in the right way. A bit of a less of a headache now in terms of the jobs market for the Fed, now that there are more cracks appearing. So if there are some doves on the Fed board, maybe looking for rate cuts, that could get a few more dissenting votes on that side of the ledger, maybe come September.
In the meantime, broader equity markets, the AI exuberance continues to build. Obviously, there's a bit more volatility being introduced, but as Shery mentioned, volatility has fallen well down even when it comes to the Korean market.
That's right. Of course, July we had a number of episodes where AI was shunned, but then I think what happens is once the dust settles, once traders start searching for yield again, they tend to gravitate back towards that AI and tech picture, and I think that's what we're seeing at the moment. I think that the US earnings season, that went some way to dispelling some of the fears that were building up about valuations and sustainability of operating margins. They're still lingering to some degree, but like I said, it has been lessened somewhat because of some of the bumper results we've seen from the likes of Microsoft and Amazon and the like. So AI trade looking a bit better now than it was, but still some lingering fears about the sustainability moving forward.
Well, the question is always going to be return on investment, right? Are we getting a better answer out of China on that and the China AI names, given the spend?
Well, that's the big deal at the moment, isn't it? Sort of how China will compare to the US counterparts on that efficiency standpoint. I think, US earnings season, I think that gave us a better idea of what the sweet spot is for CapEx. So in terms of CapEx to revenue ratio, I think what we're learning is that the cloud companies, they're sort of the gold standard for CapEx efficiency. So Microsoft and Amazon, for example. So difficult to put a number on that ratio, 35%. 30% perhaps. Outside of that, when there's a bit more of a cloud over, sort of, no pun intended, about sort of what the window will be to get a return on that investment, I think that's when the market gets the anxiety levels up a notch and isn't willing to have the same patience that they have for the likes of Microsoft and Amazon.
Has it also, when it comes to picks and shovels and across the supply chain, has it given you a better idea of where perhaps valuation entry points should be?
Yes, I mean, I think that on that front, I'm still quite bullish on the chip manufacturers themselves. I think the supply-demand dynamics are still in their favour. I think when you have full order books moving forward, then the the risk to your revenue is not on the order book side, it's on factory throughput. So I think while that's looking healthy, I think at least through the end of 2027, I think they're still looking in fairly good stead at the moment, and pullbacks are probably buying opportunities. Longer term, yes, there are questions about, say, Chinese competitors moving forward, increasing supply. And demand and supply matching more down the track, but markets are forward-looking. But we know what Kane said about the longer term. So I think in the here and now, I think through 2027, I think the chip names are still looking pretty good.
Do you worry about the froth? I guess it's a bit more of an existential question. But when you start having these circular funding scenarios, circular financing scenarios, do you start to question whether things are getting a little bit concerning?
Yeah, there is a bit of a concern on that front. I mean, I think that the NVIDIA one, I mean, they certainly pulled in a number of big names on Wall Street, so I think they're certainly selling the proposition well. So I think that calmed the market nerves a little bit once again when you're getting these names outside of the tech space itself, and on the banking side of things, if they're putting their funds into it, I think that's a bit of a vote of confidence in it. So, but look, let's see what happens when we have, say, IPOs moving forward, and whether those valuations, I'm sure they'll probably be eye-watering, but whether they're still capturing the attention of the market, say, as SpaceX did in this year. So let's see how that plays out, whether that appetite for AI, particularly on the IPO front, whether that gets sustained moving forward.
Yeah. What are you finding compelling outside of the AI story?
Still bullish on gold structurally. So you mentioned that it has had certainly a better start of things to August compared to July. I think the intervention to boost the yen, gold was a indirect beneficiary of that because it dragged the US dollar lower. So I think that to move gold above its trading range it had been occupying between about 39.50 to 4,200, saw it break outside of that range. And I think that combined with ongoing appetite from central banks to create some separation away from the dollar, that should underpin gold moving forward.
That's the expectation. You'll see more purchases from China, for example.
China, Russia, Turkey as well, for example. So I think that should provide a base of support for gold. Headwinds for it at the moment are still those elevated oil prices and a dollar which is hanging just under the $100 mark in terms of the dollar index. So I think if we did get some reprieve on the oil and dollar front, that could open the avenue higher for gold above 4,500. 5,000 could be a bit of a stretch this year, but perhaps in Q1 2027.
That reprieve, insofar as it came from the joint intervention, that's probably going to continue to fade.
That's right, an artificial impact on the market, but I think what it has done is bought some time for market dynamics to move in favour of the yen and by extension in favour of gold as well, if we did see a pullback in US yields and the dollar. So in terms of, what could those favourable dynamics be, it's been mentioned about a possible Bank of Japan hike next month. If that was combined with a US hold, for example, that could shrink that JGB to Treasury yield differential and maybe give the yen a bit of breathing room and by extension help gold against the dollar as well. So let's see how that plays out.
I mean, it's interesting that even the government, the Prime Minister, is now supportive of a hike from the BOJ, right? Do you think the window has closed for kind of decisive and impactful action here?
I think it'd be more of a measured action. I think they're certainly priming the market for, I would say, an increasing in rates to support the yen. I mean, on the inflation front in Japan, it's not out of control at the moment. Projections are that it will move higher in the second half of this year. But I think they've got a bit of room to play there in terms of the inflation side of things. But I think if the Bank of Japan does hike rates, I think it will pretty much just to support the yen at this point in time. We've heard from Scott Bessent, I think further US intervention, I think that could certainly happen. I believe him when he said whatever it takes, echoing Mario Draghi. So I think the US doesn't want to see Japan dumping those, treasuries that they hold in great numbers and put higher pressure on the US yields at the moment. So I think certainly mutual interest from Japan and the US to keep US yields under control and get the yen on a more even footing. So are the lows in for the yen for the year? Quite possibly. Certainly not a certainty, but I think we could see it maybe operating in sort of that 153 to 160 range for the rest of the year. Approaches above that, that's when we'll get those murmurs of further intervention. Let's see if that FEMA facility comes into play again to facilitate the US or Japan not dumping those treasuries, which is really the fear of US officials at the moment.
Tim, really great to have you with us. Tim Waterer, who's a Chief Market Analyst at KCM Trade. Shery.
And Haidi, just as Tim was mentioning about the weak Japanese yen, that has really given a boost to a lot of these tech names, especially in the semiconductor side of things. Here in Japan, on today's session, we are watching a lot of those memory and storage stocks, not only in Japan, but also in South Korea, because overnight we heard from SanDisk announcing a financial model for revenue growth at an investor event, which was very well received. We know that SanDisk is up more than 500%. And take a look at some of these defense names, because we have heard from President Trump. His administration is putting a 15% tariff on drones and drone component makers from the likes of Japan, Korea, Taiwan, and the EU, among others. So these are some of the stocks that you'll be watching, and you can see the downside early in the session. This is Bloomberg. President Trump is applying a 100% tariff on some imported drones and their components. The move could heavily affect Chinese manufacturers like DJI, which last year accounted for about 70% of the U.S. market. For more, let's bring in Bloomberg Digital Politics editor Romy Varghese. Romy, this is not necessarily just aimed at China. Allies are being taxed as well, but it's nothing compared to what's happening to Beijing.
Absolutely. I mean, in the announcement today, the U.S. said they were making this move because it was too reliant on foreign drone makers. But this is clearly aimed at China. For drones that are smaller and don't pose a risk to national security, that tariff is at 25%. But the tariffs for countries that have cut trade deals with Trump, those tariffs are at 15%. We're talking countries such as the EU, Japan, and Taiwan. In the UK, drone tariffs would be at 10%. So this is definitely aimed at China, with these tariffs at 25% going up to 100%. This is clearly a retaliatory measure toward China.
But as you said, potentially some of those beneficiaries could be countries that have achieved the deal.
That's right. Like countries such as EU, Japan, and Taiwan, they would see tariffs on drones around at 15% based on these earlier deals. But, clearly the United States is saying that it's too reliant on foreign drone makers. And this could really shake up the drone market globally. I mean, as you mentioned, DJI, accounts for 70% of the U.S. commercial drone market. And we saw shares of U.S. drone making companies rise post-market. So this can really shape the competitive landscape for drone-making companies.
Could these tariffs also shake up the expected Trump-Xi meeting in September?
This certainly raises the stakes of this meeting. Clearly, I mean, we have seen the U.S. and China engage in these tit-for-tat measures leading up to this meeting next month. Now, we don't have any reporting that the meeting will be derailed. I mean, even in the last batch of retaliatory measures, we were told that, the reaction from China was restrained and measured. But of course, this is certainly going to raise the stakes of this meeting, and each side will be prepared to dig in and, wield that leverage they have.
Bloomberg. Romy Varghese there with the latest. And speaking of tariffs, Australian Prime Minister Anthony Albanese says President Trump has agreed to consider a full exemption or at least no increase to US tariffs on Australian goods. Albanese says he made the case during a call with President Trump, highlighting Australia's free trade pact and record when it comes to combating forced labour. Australia is currently subjected to the 12.5% tariff rate. And as the US and China compete for AI leadership, consumers are taking very different views of the technology. Surveys are showing many more Chinese are optimistic about it compared to Americans. Let's bring our China correspondent, Min Lo. So, Min, around the world, there is this concern and development of AI backlash, right? Why are we seeing such a big difference in terms of attitudes towards the technology between the US and China?
Yes, there is a huge difference, and it's not just between the US and China. You look at this survey that has been published on the Stanford University AI Index, and it shows that people's optimism towards AI is much, much higher in countries like China, but even some Southeast Asian countries like Indonesia, Thailand. There you go, China looking at, I think, close to 80% or so, and the US below 40%. Edelman has a different survey which shows a similar trend when it comes to trust towards AI. China also among the top of the list at more than 70% trusting AI versus, again, less than 40% in the US. And there are a number of reasons for this, right? One is that a country like the US, which has been very developed already over the last 2 decades, people are already familiar with big box retail. They have reliable mail, for example, and their experience with the explosion of technology in the last few years has been one of, data privacy invasion, harm towards children, and a lot of concern around the over-concentration of power in the tech firms. Whereas in a country like China, the last 2 decades, it was still rapidly developing, and a lot of people's experience of technology has been very empowering. You think about all the people in the rural areas that suddenly can sell their products on e-commerce channels. Suddenly, they have leapfrog credit cards and go into a cashless economy. They can enjoy, very fast delivery with cheap sort of door-to-door delivery. So there's been this sense that AI has brought a lot of convenience, a lot of empowerment. So that really shapes people's perception and willingness to try new technology. And the other related factor as well is about how the government regulates the technology. And in the US, again, you see this revolving door where tech executives sometimes become, part of the government. They're raising money to fund their own campaigns to run for office. Whereas in China, tech firms are really under the thumb of the government. They're worried about crackdowns, for example. So there is this trust that the government will not let these tech firms run wild.
Are there any practical implications of this when it comes to the pace of AI development or adoption in these markets?
Yes, definitely. So, of course, the AI race is heating up, and a lot of it depends on how these tech firms bring the technology forward. But the key thing about market adoption, it really hinges on how willing people are to try and to use new technology. And here is where China perhaps has an advantage over the US, because Chinese users are far more willing to experiment with new products. And this gives a lot of room for startups to come up with new applications to test the market to see what really works. So while China might be lagging behind in some of the foundational technology, the chips and the hardware, they might be, they might have a much more fertile ground to experiment with new applications, downstream sort of products. And it's not just, people using these products in the workplace, right? In China, it's part and parcel of people's daily lives, children teaching their elderly parents how to use AI just to, so that they can be more independent in their lives when their kids are not around. So we're seeing very high proliferation rates of AI products in China.
Bloomberg's China correspondent Min Min Lo there. More ahead here in the Asia Trade. This is Bloomberg.
JD.com's ADRs tumbled after its first quarterly revenue decline since the company listed in 2014. The results highlight a growing divide between improving profitability and subdued consumer demand in China. Bloomberg Intelligence senior consumer and technology analyst Catherine Lim joins us now from Hong Kong. And Catherine, you really have to look under the hood when it comes to JD, right? How much of the issue and problem for investors was the quality of the recovery here?
Right. You're right to actually highlight that it is the first revenue decline that we've seen from the company. But the reality is that the revenue and the profit did actually beat estimates. So, the reality really is that, the question around the company right now is how much of this is really going to be sustainable going forward. And sustainable, the issue here is that the company did give a very bullish outlined and guidance into the second half of this year, with revenues and profit expected to actually accelerate going into 2027. But a lot of it is what I would call like a cost mirage, because we have a significantly calmer food delivery operating landscape, easier year-on-year comps, which again brings us back to the question, how sustainable is all of that going to be, even if it comes true in the second half of the year, that we're going to see revenue now rebounding, profits getting stronger, but 2027, it's anybody's bet at this point.
Yeah, you're just saying that guidance for 2027 won't hold. At this point, what do you see as potential growth drivers for JD?
Right. If you actually look at, what is on the table right now, yes, they are doing better in some of the general merchandise. They are making inroads into bringing more beyond the electronics and home appliances, which is actually still riding, even though on a more subdued basis on government subsidies. Now, two things to actually, take note here is that, going down the road into 2027, and as you've actually highlighted, China consumption isn't all that great. We'll probably see evidence of that next Monday when China releases its retail sales numbers and economic data. Then going into, the entire operating landscape of general merchandise, which is grocery. Question now really is that how much of that competition is going to come through? Because we're probably also going to hear from Meituan when they report that grocery is a big thing for them.
So, Catherine, JD talked a lot about AI, new LLMs, AI agents, partnerships as well. I mean, isn't that a little bit risky right now in this environment? When you think about AI, you also think about all of that spending that will go into it, and you can see the reaction on Tencent, for example. How did it sit with you?
Right. It brings us back to, what you've actually also asked earlier. We're looking for the growth drivers right now. There are investments that the company is actually putting into AI, like everyone else. And, they've actually been quite explicit about this, that, their R&D expenses in the second quarter surged on the back of some of these expenses itself. And they're going to continue to actually, invest in these areas. Not just that, of course, Joybuy in Europe is doing well. It is a loss-making entity that is driving the ex-China top-line growth. But, the reality is that the more you actually sink into this business, we're going to see whether the scale actually materially comes in to actually help lift the profits for JD again into 2027. So, I'm with you as well that, we're going to see more of these investments, and at some point in time, after all of the base effects that we've just discussed fade off, question now is what is the sustainable margin for JD.com?
Bloomberg Intelligence Senior Consumer and Technology Analyst Catherine Lim there. Later this hour, we'll be speaking with Jennifer Sung of Morningstar about the state of Chinese consumer demand, the outlook for retailers, where she sees opportunities in this market. More ahead here on the Asia Trade. This is Bloomberg.
Is the Bank of Japan going to be hawkish to support the currency? And heretofore, they've been a bit deliberate in terms of moving it. This moving in September to sort of stabilize the currency is a big deal. Intervention, I've watched intervention happen over time. You need to really keep going with a lot of firepower. I would argue it's not the most durable way to get there.
BlackRock's Rick Reeder speaking to Bloomberg about Japan's options for stabilizing the yen. And we've seen now markets pricing in more than 60% chance of a rate hike by the BOJ in September. But sources also telling Bloomberg that we could potentially see the central bank considering a September rate hike or an October rate hike. Is it moving the markets, though? Not necessarily, because markets have already thought that the BOJ will need to hike rates. What's important to the markets right now and investors is what happens after that rate hike, the pace of tightening. In the meantime, we continue to watch the JGB space. Of course, we were very close to that record high around the 5-year yield, the 10-year yield also very close to that 30-year high already because of these concerns around fiscal policy here in Japan. So we'll continue to watch that. The Nikkei do watch the tech sector. We did have a lot of news over on Wall Street with that SanDisk and memory pricing and their expectations of revenue growth. Those are some of the sectors to watch. With the weak Japanese yen, we have seen perhaps some signs of life. Together with the stock market, we have seen rising wages, inflation just below the central bank's 2% target. But while young workers are reaping the benefits of these changes, pensioners are feeling the strain of a higher cost of living together with what we've been talking about, a weak yen. Take a look.
On a Saturday afternoon, thousands of people packed this convention center in Tokyo for an investment expo, looking for new ways to build wealth, from real estate to cryptocurrencies to gold coins. Among the speakers, one influencer tells the audience she accumulated $431,000 in wealth while still in her early 30s. She used to earn only $1,200 in her 20s. She's part of a shift in how Japanese people are choosing to invest instead of save. For 3 decades, Japan unleashed economic stimulus while prices and the economy stayed flat. Now inflation is back around the central bank's 2% target, and it's looking like it's here to stay. With rising prices, profits are growing. Workers are getting the strongest wage gain in decades. The stock market is near historic highs, thanks in part to the AI boom. And with it, animal spirits appear to be coming back.
With everything happening around the world, I worry about my financial future, whether I'll be able to support myself while I'm working and after retirement. I wanted to reduce that uncertainty, so I became interested in investing.
The benchmark Nikkei 225 index has surged over 20% so far this year, and first-time investors who piled into stocks with the help of a government tax-free savings program have ridden the wave. It's helping fuel a growing narrative of Japanese dynamism.
Japan is back.
But there are fears that inflation is also worsening inequality. Analysis by Nomura shows consumption in 2025 for the top 20% of the population far outpaced that for other groups. Chieko Sugai lives in Murakami, a 5-hour drive from Tokyo. The 72-year-old widow finds surviving on a pension of around $670 a month increasingly difficult.
The price of kerosene rose to 180 yen, and I was really shocked. That was what worried me the most. I used to be able to keep my heating cost under 30,000 yen somehow. But suddenly, I had to pay 36,000 yen. That took a big chunk out of the money I have to live on from my pension. It is quite hard.
Sugai isn't alone. This food truck driver sees a wider trend.
People used to shop without paying much attention to prices, but now they're asking, how much is this? And checking their wallets before deciding what to buy. Because many of our customers are senior citizens living on pensions, they're the ones hit the hardest. That's why we can't increase prices too drastically.
For households with lower incomes, the weak yen is expected to continue eroding savings.
A weak yen is great for the stock market because it improves earnings, but at the same time it's bad for the Japanese people because Mr. and Mrs. Watanabe is losing purchasing power.
A Yomiuri poll in July saw Prime Minister Takaichi's popularity plunge to 57% from a high of 69%. Among respondents, 71% said their major concern was the cost of living. Takaichi has sought to cushion the blow of higher prices with subsidies and has decided to suspend the sales tax on food. The question is how much those measures will resonate with Japanese voters.
China's luxury sector has finally turned the corner after a years-long downturn, but what's emerged now looks very different from its pre-pandemic highs. Our Bloomberg opinion columnist Juliana Liu argues that Chinese consumers are becoming more selective and value-conscious, forcing luxury brands to adapt. She joins us now from Hong Kong. So, What are the differences that we're talking about in terms of this new luxury?
Yes, so I think there is no other way to put it except to say and to admit that these shoppers are essentially trading down. So very unlike the pre-pandemic years where the industry essentially tripled in size in the 5 years to 2021, shoppers don't have thousands of US dollars to spend anymore on handbags and essentially jewelry. But they still want to look good. They still want to feel good, especially during an economic downturn. And what they're doing is they're switching their purchases to things like high-end skincare, cosmetics, fashion, particularly like shoes. Expensive sneakers in particular. So we're seeing this play out in the earnings of some big Western companies. So L'Oreal, for example, has said that its North Asia business in the latest quarter was up 4.5%. That's pretty strong, and that's mainly driven by a 10% increase in its Luxe division. So Helena Rubinstein, Lancome, Kiehl's, these are doing pretty well in China. You're seeing the same pattern at Estee Lauder. Beiersdorf says that its La Prairie line is seeing a lot of momentum. And interestingly, L'Oreal says that the mass market has turned negative. I think it's pretty clear that shoppers in China are turning the budgets that they have to play with to other areas.
Yeah, you just have to see how the Labubu economy, right, in terms of wanting that dopamine hit without spending too high on that price tag. But are we seeing that response from luxury houses? Because traditionally the whole point of these products is that the fact that they're expensive is part of the allure, right? It's part of the marketing and the branding.
Yeah, for sure. And I think it's still part of the allure. And certainly the good news is that collectively the Chinese luxury shopper is back. So that's why, after two big falls in the last few years during the pandemic years, it's actually great to see that collectively as a group they're coming back. And McKinsey expects that there will be growing for up to 6% a year in the next few years. And it's certainly the strongest kind of expansion that anyone is expecting in the luxury market.
Bloomberg opinion columnist Juliana Liu there. Coming up next on the Asia Trade, we'll take a closer look at the Chinese consumer. In particular, the opportunities that investors should be watching. Morningstar's Jennifer Song joins us. This is Bloomberg.
We're looking ahead to Chinese earnings due today. Bloomberg Intelligence says Zijin Gold's profit growth in the second half could come under pressure from lower gold prices, though output growth may help cushion the impact. Bloomberg Intelligence also thinks Kweichow Moutai's strong cash generation could support another dividend increase, even as sales growth slows in the second quarter. And finally, investors will be watching whether weaker Macau gaming revenue and softer spending by premium players weighed on Sands China's results. Let's discuss all of the earnings season over in China. Of course, consumer strength as well. Jennifer Song, senior equity strategist at Morningstar, joins me now. Jennifer, great to have you with us. Should we start with Moutai? I mean, it seemed to be sort of the exception to the Baijiu downturn that we've seen recently. So what do you need to see in these results in order to gauge resilience?
Okay, so for the results for tonight, we'll expect more flat earnings for Moutai because the overall market still suffer from the demand headwind. And even for Moutai, we see some resilience for its flagship Feitian Moutai. We still see some weakness in higher end product. So overall, we'll think the earnings to be largely flat compared with a year ago. Yeah, and also the earnings, we'll need to look at the dividend because the company used to have a dividend commitment for 75% payout. If any surprises in dividend, that will be positive for the share price.
Is this a reflection of the weak consumer demand that we're seeing in China?
Yes, I think so. And also last year, there's a new round of alcohol ban. It really dampened the investor confidence for the whole sector.
What about the cost side of things? Because we have seen Moutai also raise prices in July.
Yes, because Moutai has an extremely strong demand for its flagship product, Feitian Moutai. So the company actually raised the ex-factory price 2 times this year. So that's very encouraging for the whole sector because is in such a weak market, the company still can raise the wholesale the ex-factory price. That's very decent. So that should mean the demand for Moutai is quite resilient. Yeah.
Does that signal also perhaps the strength that we're seeing in some sectors of the consumer space, whether it's the wealthy ones and those people that can actually afford more premium products?
Yeah, that is one of the reasons because still strong brand power that plays the very important factor. And also when the retail price is just coming down to around 1,700 from over 3,000, that make mass market more affordable for such a premium product. So that also boosted demand for Moutai. But for the overall sector, we still see some weakness because the competition remains high.
Jennifer, I know that you also follow the casino space, and we're seeing Macau really not doing well when it comes to comparisons from years past. I think the sharpest decline and pressure that we've seen since COVID or so. What are your expectations for these results from the gaming sector?
Actually, overall, the result in second quarter is a little bit weaker. One of the reasons is in June, there's a World Cup event, so that some premium customers just deferred their visit to Macau. So we see generally in June and early July, the overall GGR to be very weak. So they have really impact the second quarter result. But management generally sees volume rebound since mid of July. And in August, the volume is already rebound to the pre-event levels.
What are you seeing in terms of the divergence between premium VIP players and mass consumers?
Actually, the casinos, they are still focusing on the premium segment, especially for the premium mass segment, because it's easily to give them promotions to boost demand. But overall mass market is more tied with the overall consumer sentiment and the consumption challenge in China. So that's why the mass market demand is still haven't yet to recover, but the premium, especially premium mass segment, that perform quite well.
I mean, we've been talking about the consumption side of things, but how much is it also to do with the fact that Beijing is tightening controls on cross-border capital flows?
Actually, that market just read it as a slight negative news because the government likely to tighten the money flow that will have some impact to Macau, especially for the high-end segment. But in the real demand, we see the volume just flow back after the World Cup event a little bit. So the overall segment in second half, we will see like single-digit growth, like 4% YOI growth in the third quarter.
Yeah, Jennifer Song, Senior Equity Strategist at Morningstar with the latest on Chinese earnings. Thank you. And coming up, more earnings to come. Lenovo CFO Winston Cheng joins the China show after the company posted strong results, revenue beat powered by AI infrastructure demand. They'll be discussing whether Lenovo can turn that AI momentum into lasting growth. We are, of course, seeing supply constraints, rising component costs beginning to bite as well, Haidi.
Yeah, Shery, let's take a quick look at some of the corporate stories that we're tracking this hour. And CXMT has eclipsed Tencent as China's most valuable company, highlighting investors' growing preference for AI-linked chip makers. The Shanghai-listed firm was worth about $524 billion as of Thursday's close. That milestone coming in as Tencent faces investor concerns over rising AI spending, while CXMT has emerged as a key proxy for China's AI ambitions. DeepSeek is sharply raising prices for its flagship AI models, increasing some rates by more than 4 times starting this weekend. The move comes as the Chinese startup prepares for a potential IPO and looks to improve profitability. Despite the hike, DeepSeek services will remain significantly cheaper than those of rivals, including Anthropic and China's own Moonshot. More ahead here in the Asia Trade, this is Bloomberg. Take a look at what we're watching when it comes to oil, and we're finally seeing a little bit of reprieve when it comes to these oil prices, despite, of course, not a great deal of movement. The Hormuz deal has essentially stalled at this point. We're seeing the persistence when it comes to attacks on ships as well. So all of this keeping the market on edge, but oil at this point holding on to that decline, about 0.1% apiece when it comes to both trading in Brent crude and New York traded crude there. Gold has had quite an interesting week when it comes to trading at pretty close to that 10-week high this week, but traders now kind of reweighing what we see from the Fed going ahead, as well as the tension in the Middle East. So that recovery faltering a little bit, off by 0.4% after what was a steeper retreat that we saw below still that $4,400 an ounce level there. Still, we are on track for a second weekly gain for gold despite that pullback. Well, as AI adoption accelerates, India could see a sharp increase in power needs from data centres. Tata Power CEO Praveer Sinha expects about 30 gigawatts of demand by 2035. Other estimates go even higher. In the latest episode of our emerging podcast series, Manaka Doshi takes a look at whether the AI boom has India headed for a grid shock.
I'd love to start talking about the Google experiment, as we call it, where Google has committed $15 billion to build an AI hub in India to serve India's needs, but also to serve Google's needs across the world or across the region. And to do that, it is not only going to set up captive power, but it has also just been granted a deemed distribution license. Explain to me the kind of pressure AI is going to put on the power estimates that you all have shared so far. And what do you make of this Google experiment and how it's going to work?
So right now in the country, we have about 1.5 gigawatt of supply which goes to data centers. With whatever has been announced, we are expecting that this will become about 10 gigawatt by 2030 and about 30 gigawatt by 2035. So that's the type of number that now from 1.5 to 10 is not a great number. Mohit will agree that we'll be able to cater to that. Even 30 gigawatt by 2035 is not a great number. We'll be able to handle this. As far as you mentioned about the DEEM license, the Google experiment. Yeah, the Google experiment is because they give a DEEM license, then as a distribution company, you don't have to pay the cross-subsidy charges. Now, when you do renewable projects and you are buying power, you need to pay cross-subsidy charges to the grid. Here, you will not have to pay cross-subsidy because you are a deemed licensee and you can buy that power. And some of the cross-subsidy surcharge or the other surcharges that one has to pay, you don't have to. So that's it protects. Also, it gives you the freedom that within your campus or within your area, you can have your own network. You can bring the last mile connectivity from the grid to yourself. And to that extent, it gives you the flexibility of arranging power and making it more competitive compared to the otherwise industrial power that you would have consumed.
Assuming there will be humongous demand for data centers, given AI adoption, across the country, do you expect that most of them will rely on captive power and on this sort of deemed distribution license, thereby remaining entirely or almost off-grid and building their own parallel power structures, to the national grid?
So our point of view is slightly different from what Praveerji has on AI data centers. We feel they are likely to be bigger than 30 gigawatts. May not be in 2035.
AI demand, you're saying, is going to be bigger than 30
because India is actually very uniquely positioned in terms of supplying power. And India is also uniquely positioned in the sense that we can do RE-based supply at much larger scale to these data centers, because what we understand from the limited interactions we've had with most of these people, their requirement is like today.
Yeah.
They are keen to have the supply starting in the next 18 months. They don't want to wait for the next 5 years to set up a coal-based or whatever kind of power supply. They want it. So RE is very
renewable energy.
Renewable is actually the one which can do that in the shortest time frame. And incidentally, as per our research, that's also the lowest cost, whether you look at it on a 24/7 flat block basis or as an intermittent supply. So we feel that data centers could be a big business opportunity in India. Of course, I mean, assuming that they will all comply with the Government of India regulations for storage of data and so on and so forth.
And you can hear more of that conversation on the Bloomberg Emerging podcast, available now across platforms, including YouTube, Apple Podcasts, and Spotify. We've been just trading across Japan and South Korea for less than an hour, and you can see the Kospi already testing that 7,000 line. The Nikkei also gaining more than 1%. As we're seeing those memory names follow U.S. memory names higher, the ASX 200 being led lower, though, by materials and industrials, Haidi, as we're seeing the downside pressure on oil with the uncertainty around Iran.
Yeah, no great significant progress being made throughout the course of this week. But take a look at how we're headed as we head into the start of trading across Greater China. This is how China futures are setting up. Hong Kong tech futures are off by about 0.7%. We are seeing some upside for Taiwan on the back of this AI chip demand-related recovery story. We're seeing A50 China futures looking pretty flat at the moment. The CSI 300 index could, according to Bloomberg Intelligence, lose appeal until there's inclusion of CXMT. That's not likely to happen until the end of 2027 due to some of these index rules, but certainly we'll be watching that CXMT impact and the effect across a broader AI trade.